Today we're going to continue our discussion with our easy Forex trading strategy. We're going to carry on from last day. We're going to go a bit more in depth into the geometry and also trade management, and we're going to talk about self-management and the review process. Stay tuned, traders. We'll be right back. G'day traders, I'm Stacey Burke from Stacey Burke Trading. Another week of volatile markets. I use that term volatility in the sense that unless there's movement in the markets, it's hard for traders to make money. So we've had some fantastic opportunities in the markets this week. I've also talked about not trying to trade every single move in the market, but identifying one or two high probability setups or high possibility setups where we can position ourselves in the market near numbers, near the high or the low of the session or the day, with a tight stop for asymmetrical risk reward on that risk capital when we put it into the market. Yesterday we had a couple of fantastic examples of trade setups that gave us not only price, round numbers, and at the timings, but also gave us geometry for measured moves, which offered up to 5 to 10 times return on your risk, depending on how you were able to get into those trades. But we're going to continue our discussion today. We've talked about the high and the low of the day. We're going to show a couple more examples of that today. We've talked about the importance of that 12 candle window around the market opens. Right now, because of the volatility, coronavirus, the market's crashing, I think that the timings have been more importantly about the highs and the lows, but also the geometry. The US Open, the London Open have given us tremendous opportunities to position ourselves for some fantastic moves. And again, those trades came off of numbers. Now again, depending on where you're able to position yourself, we're going to talk a bit more today about the strong hand versus the weak hand in terms of your fills on certain price action entries, and then also risk reward. Yesterday we had a couple of fantastic examples of adding geometry into the equation and not just going for 50 pips, but some of the trades offered up to 250 to 300 pips or more depending on which pair you traded, and obviously risk reward depending on how you were able to enter into those trades. We're going to talk about patterns again in that geometry and the importance of that. But again, when you realize that these trades offer sometimes 5 or up to 10 times your risk, cutting losses is critical, because you can take a 1 hour loss if your expectancy is 4, 5, 6, maybe more on average. And that's why when you get these opportunities to participate in the bigger geometry, that's what will give you the positive expectancy much above 2 or 3 to 1. We're also going to talk a bit more about self-management, having a bit of perspective. Coming to the screen right now, there's so much chaos in the news, in the indexes, in the share market, but also decluttering yourself from all of that and staying focused on your primary purpose, and that's to execute your trading plan. So again, we talk about the daily habits and daily routines, coming to the screen prepared, knowing what you're looking for, identifying key levels. Is there structure in the market or a pattern? Are we near highs or lows when the session opens? Can you identify the round number levels? Are we inside or at a 100 pip box? So again, we're going to show some examples of identifying the 00 boxes and whether or not the market's trading between a 100 pip box, a 200 pip box, and in the G New Zealand G odd case, 300 pip boxes. If you're trading the US crosses, again, we've had just massive moves, and just using simple geometry with highs and lows for rectangles, continuations. We talk about the 3 primary things, the only things that markets do. They break out and they pull back and reverse, false break. They pull back, they fill more orders and they continue, or they break out, pull back, fill more orders and continue. We would call that a trend trade. Or they break out, they pull back, and they go into a range-bound market. So it's important with your daily routines to develop a process. So if you're coming to the screen each day with no set routine or even your daily schedule, how you map out your ideal trading day. For me, I talk about this in the 7-step daily routine for high performance traders. Each day I have pretty much a set routine, right from my nutrition, my exercise regime, my review process, my journaling, my playbook setups. I go through my charts, I review the previous day's trades, I review the trades for the week. I go through and look, what could I have done better, what did I do well, what did I do poorly, what should I have eliminated, could I have taken more out of a winning trade, did I cut my losses as tight as I could get them, was there a time stop decay in any of those positions. Little things that, again, just trying to bump yourself up performance-wise 1% each day or each week so that you're improving in the direction of the trader that you want to become, and in some cases the person that you want to become. I believe that you're in pursuit of excellence, and that probably reflects into other areas of your life, not only your trading results. So that review process is critical. Journaling, if you're not journaling, just go spend $2, start writing things down, making notes. Again, your preparation, the setups, the timings, the levels, the structure, was there geometry, all the little things that will just get you into a checklist in your mind. Write the checklist out, keep it at your desk, go through that each day. Remind yourself there is going to be some massive trading opportunities. It's your skill set that will determine as to whether or not you're going to be able to, number one, be profitable, but number two, be consistently profitable, and then number three, not doing anything to self-sabotage those results, which again, the process part is key. And then live performance. So live performance, it's one thing to look at historical charts and know that you would have got in here, got in there. I'm huge on timing. Everything is about timings in the market. We talk about the 12 candle window. We talk about levels. Timings and numbers are very, very critical in this endeavor, because if you understand the importance of timing, you will see the same behavior, and then you'll start to identify the key price levels, and you won't get distracted by a lot of the price action once they're done doing business at a level and they're going to reverse the market. That's when you want to start paying more attention to structure, looking at the bigger pattern for measured moves, and knowing that once you're positioned in the market, if they're reversing or they're continuing a move, knowing that they're done doing business in one direction, that you can calmly position yourself in the market with tight risk control and asymmetrical profit targets for achieving a bigger return on that risk capital without a lot of stress. I keep thinking about what Paul Tudor Jones said: why make trading a stressful, endeavor? Make trading a pursuit of happiness. So what that means is to have your process mapped out and really simplified. Like a lot of people, we've talked about peeling back the onion, and each layer of this has a skin to peel back of an onion of its own, because even though it's really simple, we want to position ourselves near the high or near the low, or at the high or at the low, around the equity opening times when the market has demonstrated us it's at numbers, and it's giving us price action to confirm either a trend trade, a reversal trade, a range bound trade, whatever that is, where we're targeting 3, 4, 5, maybe 10 to 1 on our risk. Now that sounds really simple, and then we're talking about bigger geometry for maybe measured moves bigger than just targeting highs and lows. We're talking about range expansions. Trade management. So, if you've been on the screen long enough, certain traders, we've talked about this in other videos, in some situations, once I park my trade, I won't touch that until it's moved a certain distance, and then I'll go to break even. But there are other things that happen in the live market that will get you to second guess your position the entire way. So they'll flash the price, they'll hit lows or highs of candles fast and pull them back, making it look like momentum. They'll hold price at certain levels and just let it sit there and let it sit there and let it sit there before they pull away. They'll widen the spreads on you. They'll flash the spreads. They'll spike candles, all without going against your position. So it doesn't stop you out, but it gets you to second guess whether or not you should take money off the table before it makes its full move. So you might be up 25, might even be up 40 pips, and they'll come back 20, 25 pips against you, getting you to second guess that trade before it makes its full expansion of maybe 150 to 200 pips or 100 pips, whatever that may be. They get you to second guess and either go to break even too fast, not take money off the table, and then when the trade does go to its full fruition, you watch it run away without you. So it's important for you to have that screen time, that experience, to know that in live time, the things that they're going to do to you that are going to freak you out. And again, even before they're ready to move, creating highs and lows and hitting both sides before they make their real move. And these are things that will come with time. So one of the reasons I don't trade Asia is, and there are some good trades in Asia. That said, oftentimes there are trades, but I'll make sure that at certain times I'm out of the market before London opens, especially if it's made a good move to a high or to a low. I know that usually when London opens, they'll stop hunt that profitable trade before they make their move, and they may even take out the high or the low of that position. So again, we're going to go through some more examples today. I've had lots of questions. Asia, 8:30 p.m. New York, between 2 a.m. and 5 a.m. the Euro London, you will usually set a high or a low, or work a high or work a low. And again, New York, 8 a.m. to 11 a.m. Now, what I haven't talked about in there as well is often into the close of New York, if we're at a high or a low, they will often make a move in that last 2-hour window between 3 and 5 or 2 and 4, somewhere in there, if they're at an extreme, possibly all the way to the other side of the market. So again, there are closing times that are important, especially on a Friday as it is today. And again, we talked about not holding positions over the weekend. Now that's up to your discretion, but with recent volatility, a lot of traders may get stopped out of a profitable position with a Monday morning opening gap. So just a little caution as we head into Friday, and with everything happening globally with the indexes, the coronavirus, and a little bit of uncertainty economically, we could see some more extreme volatility over the next few weeks. So let's take a look now again, and we'll break this down into some simple things. We'll talk about structure, and then timings, numbers, and candle patterns, and then we'll look at some screen examples. Okay, let's look at an example today of combining structure, high and low, numbers, timings, price action, and then fighting for the best price, and then looking at risk reward. But we'll also talk about the spreads, because the spreads have obviously widened out quite a bit in the last week. So basically, when we talk about structure, the market is going to give us a high and a low at some point. Now, we'll look at a couple of examples, but let's take an example of where the market in Asia, we've got a close from one session, the market comes in and all of a sudden takes off and goes up 100, 200, 300 pips, and we think, oh, this is crazy, we've missed the move, and then it comes down 150 pips. Next thing you know, it goes up and hits the high again and goes up another 150, 200 pips. Comes back down, hits the low, goes back up one last time, and then comes down again before it makes 3 peaks. So we have a 1, 2, 3, but we also have timings. Over this window of time between when the rollovers occurred, we're looking ideally probably towards the end of the Asian session. Now we talk about London coming on board between Europe and London between 2 a.m. and 5 a.m. New York. Towards the end of this Asian session, when we have a structure like this and they've made a big movement early in the session, I will often go to the screen at the end of Asia, which is sort of between that 1 and 2 a.m. window. Now often, if the market is going to give us something, we're going to see numbers. And we might even see this be, as we have this week, a 300 pip high to low box. Now we talked about using geometry for measured moves. Okay? And I've talked about using 1 and 2 full expansions of this range from high to low and projecting those down. Now, when we get these patterns, so for example, we might have a pin hammer on this third leg at numbers, or we might have an engulfment that completely reverses a previous candle on this third leg on a 3-touch pattern. This is a major reversal pattern. We might get filled 25 pips away from the numbers, okay? Now, we talked about this the other day about chasing price. And obviously with the spreads on some of these pairs, the spreads might have even been 10, 12, 15 pips. So you're talking about a 50, 60, 70 pip stop in some cases because these candles are 50 pip candles, as we've seen on some of the moves this week. More importantly though, even if you're not trading this with large capital or even small capital, get familiar with identifying the geometry. This is what I really want you to start paying attention to. As they trade throughout Asia, they will often be painting a geometrical shape, high and low. It might be a 3-push pattern, head and shoulders, whatever, 3 peaks. It could be 3 peaks this way. It might be 3 peaks this way. It might even be a high and a low that trades inside of a rectangle. Okay? It might be a descending rectangle. Okay? Start identifying if you're seeing geometry that you can then extrapolate out for measurements if it breaks out of that range at the numbers, at the market opens, or near the market opens, with price action that confirms your thesis. This is critical because instead of targeting, like, we saw this yesterday. We'll give an example of this in a minute with the pound New Zealand, pound Australian. That's a 300 pip high to low. When I talk about high and low, I'm talking about the geometric shape, not the very low of the day. I'm talking about the high and low that they've painted after they've made their big push. That market filled a 600 pip movement down below that 3-peak pattern. You're going to see this pattern again when we resume to normal trading ranges. You're going to see the same pattern present on any of the pairs. You might see it on a US dollar cross, and it might be a 50 pip movement with a 25 pip peak to trough geometry that then extrapolates out to 50 pips below there, which could be a 75 pip target or a 100 pip target instead of 50 pip target. Again, we're looking at how we can squeeze more out of a winning trade using bigger geometry rather than just targeting and trailing bars, when they move and try to get 20, 25 pips. We're talking about letting the market do the work for you. So another scenario is we might see the market roll over in Asia. And again, we talk about the template Monday to Tuesday, Wednesday, Thursday, Friday. We'll often see a down template or an up template. So we might see some pins show up on the bottom, but then we might see the market work inside and then start working the low or the high. But what we'll start to see, again, is some kind of geometric pattern. The market will make some false moves before finally giving us some kind of confirming entry, and again, we can target measurements of these ranges. Now, I talked about getting Peter Brandt's books. Fantastic, probably the best classical charting trader alive, or one of the best. Peter's been trading for over 40 years, but his charts, even though they're weekly and end of day, apply on these, whether you use hourly or 15-minute, because markets are fractal, right down to the 1-minute chart. You'll see the same patterns. But again, we're using the bigger picture. We want to be on the outsides of these ranges, selling high or buying low, and participating in bigger structures. So again, getting better at identifying the best setups where you have the, not only where you have the path of least resistance, possibly. So when markets break out of these ranges, the thesis is that when they explode and it's a strong market, they do not come back, which means that you don't have a lot of heat or stress on your trading position. So this is critical, because this is how you're going to make a lot of money in the markets. Trying to trade every move each day is challenging, and it's stressful. It can be stressful. Even just identifying the best opportunities sometimes is challenging. But when you can start to tie this in with structure, and you're looking at 3 or 4 basic patterns that show up over and over again, that's when you can sit back and feel comfortable of not taking trades, and also very, very comfortable with cutting your losses when you're wrong. There's no hesitation on that whatsoever. So again, with price action patterns, we want to see trades either ending in an engulfment style of candle formation. So again, if we've had a market that's reversing, it's not the best example, but you follow what I mean, and whether down or up, we might see a pin hammer. I guess that's supposed to be a bull candle. Okay. But not just this one candle by itself, but again, we talked about numbers. So you're going to get trades at certain timings. So if this is going to happen, and you can see the structure setting up towards the end of Asia, and the market has given you part of this equation, and you're near numbers, you might want to start paying attention to where you may better enter the market. So the market may pull away, but it may also retest that level before it finally pulls away. You may be able to get a better fill. Right now, though, I would just stick to identifying the confirming entry, knowing that the market will retest your position, but not necessarily stop you out. So it's going to put heat into. If you get filled 15 pips away from numbers, chances are you're going to get 7 or 8 pips of heat into your trade. If it's the last leg before the final move, there may often not be any stress on that position. That's fine-tuning stuff, but for now we're talking mainly about price confirming our thesis in terms of the direction that we're trading in. Now the other side of that is there are some variations of these 2-bar patterns. There's some 3-bar patterns, some 4-bar patterns that when we combine timing with that, so we talked about the hour phenomena, if you can start picturing in your head what the hourly candle looks like, and if you have multiple screens you can see the hourly chart, you know that some of these patterns will complete at the end of an hour. So we have 4 candles per hour, we might get 2 or 3, and then this confirmation pattern may happen at the end of an hour prior to the market closing or opening, which again, the next hour is usually the one that pulls away. So just some things to think about. Again, structure, pattern, major reversal patterns, that gives us our bigger picture. Then we can look at our intraday highs and lows, our numbers, the timings when the market opens. Are we near the high, near the low, or are we inside of a range? If you're inside of the trading range, has there already been a trade that's happened and you're in the middle of that trade? You don't want to counter trend the peak formation or the trend that's already in play. So I have some basic sort of things that I repeat to myself. DNC, do not counter trend, do not chase. I don't chase trades. I know there's going to be plenty of trades. If I come to the screen and the market's already pulling away, I don't feel that I've missed out on. I used to want to chase those moves. Now I understand that often they're painting a bigger structure for the real move that's about to occur later on. So again, think of timings. If you've missed one trade or you've missed a move, think timings. There's going to be another one when the next market session opens or when one closes. So we'll take a look at some examples today. Keep it simple, traders. Spreads, again, the spreads even on the tighter pairs have bumped out to 4 and 5 pips, sometimes 7. But again, we're targeting bigger ranges right now, and it's not so much about the spread. It's more about your process and executing and being patient, trying to get the best fill on your price, and trade smaller. If you're concerned about size or anything else, trade as small as you can and focus on the process and focus on risk reward. If you're risking 25, 30, 40 pips, hopefully you're going for 150 to 200 pips in that trade. So we'll go through some examples today. Keep journaling your trades, keep reviewing your process. Know that you're going to have some challenges in live time with, prepare yourself. Know that you're going to execute when certain setups happen at numbers at certain times. Don't let the price action of the flash, of the spreads, the quick moving candles, don't let anything distract you from executing your trading process. Stay disciplined, stay focused. We'll look at some examples now, and may the markets go with you.
Okay, traders, let's take a look at some examples of combining structure, high and low of the day, timings, round numbers, price action, and then fighting for the best price to enter the market, and then targeting not only asymmetrical risk reward, but also measured moves if geometry gives us the structure that we can target that with. So here's an example. Yesterday, we'll just look at the blank chart first. We see the market take off in Asia and make a massive move, taking out the previous day's high and giving us some pins on top. But if we look and step back from this, we see one push, two pushes, or one big push to the high, two pushes, and then a third push that engulfs on this candle, which happens to be at 1:45 a.m. New York. Now if we go back and put our numbers on here and we look at this chart again and we draw, we've obviously got a high, and heading into the Asia close we have a low. We project that across. Obviously the low of the day is down here, but again, in terms of redrawing our highs and lows heading into Asia, we see this engulfment candle. But again, one leg to the high. They've hit the high twice with pins. So we see pins on top. They've put a pin down below, which is an anchor point now. One of these pins is going to break. But we also have a second push and then a third push, and then an engulfment candle at the end of Asia. Now, traders, we talked about market timing, so this is the close of the Asian session. If traders came back later into the London Open, we see the 330 candle with pins below the low of that anchor point, again at numbers, at round numbers. But again, targeting, if we go back just looking at numbers without even worrying about measurements, we see a 100, 200, 300, 400 pip range from high to low. Now if we were to just go on the numbers, which basically that is the highs and lows, we see a full range expansion down, as well as almost a second full range expansion down, which went to the low of the previous day. So again, using geometry, some traders, because of the volatility in the spreads, perhaps may not have held on to positions that far, or they may have traded it through to the round numbers. They may have been positioned up here, and again you can see the market will come back to test traders break even stops, which is why it's important that we take profits. We can get back into some of these moves. If you get evidence of a pin below round numbers or at round numbers, be looking to possibly exit that trade with profit. Now this is probably a 3-to-1 trade. 3-to-1 and a pin bar may be a good sign to exit that trade. Now again, this is a fairly extreme example in terms of the ranges, but this is what we're up against at the moment in terms of volatility. Obviously the stop in this particular case is probably almost 100 pips, but it's more about identifying structure, patterns. This same pattern will show up over and over again. A 3-push pattern. They were working the high of the day. They hit it once, twice, 3 times. It kept getting lower, but you'll notice that they're jamming it into the previous peak before shifting away. Pulling it up, shifting it away. If you're chasing price, you can be assured that the market is trapping you as far away possible as it can from the real direction that it's going to move in. So again, we see headed into the US session, they hit it once, twice, 3 times to the high, before pulling away and resuming the trend down for a full extension of this range. 1, 2, 300 pips, 1, 2, 300, and an extra pin below to stop out traders that were long, possibly from the Asian or the previous night's session. So another example of using geometry, if we project the high of the last high of the US session, we see the market made pin lows in Asia and at the US close, and as we headed into the Asian session, Europe open, you can see that the market was trading just simply between double zeros throughout most of the session. It came up in the Europe London Open to hit the highs of the day before reversing and stop hunting traders that may have been long off the bottom, and then consolidating above that halfway point inside of the peak and the low that it had just painted in the Europe London Open. Now, if we look at bigger structure, we can see that the market also gave us higher lows and consolidated inside of that peak before going 1, 2, 3, which we talked about in previous videos. 1, 2, 3 is either a blow off or a stop hunt. What happens next is either going to give us information for a possible continuation of a measured move or a reversal. That market gave us an engulfment, and then the little 15-minute hammer at numbers that stop hunted the breakout traders for a measured move of this ascending triangle pattern. Now we can use numbers, we can use the high and low. Some traders will use the initial high and the initial low that the market painted in Asia. And again, either way, we see that it did two full expansions for approximately 275 to 300 pips. And again, breakout traders is an example again of breakout traders that would have been profitable even on the breakout of this bigger geometric structure. So again, it's important. Pay attention to numbers, okay? The candle patterns, the market was working the low. They were jamming into the lows, jamming in, pulling away and filling all the gaps on the bottom of the market before finally shifting away and doing a measured move, which obviously was a stop hunt on the previous day's profitable trades. We'll take a look at one more. The pound Swiss was a great example yesterday of combining price action with bigger structure. The market gave us pins. We're at the low probably of the year. The market came down in one push, two pushes, three pushes, and went sideways, and at the Europe changeover gave us a pin hammer. That pin hammer is the first mouse in a smaller geometric rectangle. Okay, whenever you get patterns inside of patterns, bigger patterns, they will often be the catalyst for bigger moves. We'll just lower this down a bit. And we see that this market gave us a breakout and then of course a pullback. You'll always get a stop hunt on traders who have gotten in and there's been a breakout pullback. This is our outside structure now for a measured move to the high of the day. So the market gives us our trade. They stop hunt the trader who's got it right. So traders who went to break even too early are stopped out before the market resumes its trend. Once the market has broken through this swing high, then this trader can feel reasonably confident to go to break even, knowing that if this fails, he could definitely get stopped and not only stopped out, but stop hunted below his original entry stop. Then we look at the bigger structure. Take our range expansion and we see that this market did 1.5 expansions of this high to low range. Again, even if we just look at the numbers, we see we have at least 100 pip box, 250 pip boxes. If we were to take 2 times that range, that's another 200 pips on top of that high. This trader then at that point we see how strongly this market is moving into the US session, they may even want to trail these bars up to the high. Once it hits, I have a rule that Peter Brand has taught me: when a market hits its target and it's moving quite strongly, if I've decided to trail that, I will trail from the bar that hits the target. So I will immediately start trailing once a target's been hit underneath of that bar. The other rule that I can use occasionally is the 2-bar rule. I will follow 2 bars behind a strongly moving market up to my target. So again, just looking at structure, bigger picture, geometry, tying that in with our number levels at the timings, near the low or the high of the day. And then looking at how we can squeeze, instead of going for 50 pips or 25 or 75 pips, looking at the bigger structure and then looking to make sure that the market behaves the way we expect it to when it's going to do a range expansion of this geometry. So again, look at the bigger picture, then get down, break it down, high and low of the day, equity opening times, that 12 candle window, round numbers, asymmetrical risk reward, cut your losses, make sure you're taking profits. If a market starts to consolidate and you're in this move right here and you're fearful and you get stopped out or you take money off the table, be prepared that that market could give you another entry to get back in once it's done its stop hunt. So again, traders who are savvy may want to take a second position once the market confirms that it's going to resume its original drive in that long direction. So hopefully you got some value from that, traders. Keep it simple, target structure, bigger geometry, candle, let price confirm your thesis and then fight for the best price. So if you get filled away from the numbers, if you want to take a partial position or even go in on a smaller time frame, fight for the best price. Let the market do the work for you. Look at the bigger structure. Even if you're doing one range expansion of this, look to squeeze more out of your winning trades. Keep your losses tight. Stay disciplined, stay focused, and may the markets go with you.
Hi traders, it's Stacey Burke from Stacey Burke Trading. If you haven't done so, please head over to my website at staceyburketrading.com. I create updates on almost a daily basis and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined and may the markets go with you.